What's up, guys? It's yours truly, the Money-nista. 20 years in audit, accounting, and tax. I do have a formal education in accounting, 13 years in the large business and international division of the Internal Revenue Service, examining large entities that report 10 million or more in gross receipts on our assets and the high net worth individuals that own these entities, right? So I want to talk about book accounting versus tax accounting, right? And when I tell people, look at how the tax code treats the transaction, there are certain transactions for accounting purposes that are not acknowledged, that are acknowledged for tax purposes, which reduce your taxable income. So I'll give you an example. You have your rental income, right? I like to use real estate a lot. But this applies to business ownership as well. And you have your expenses, like your mortgage interest, your property taxes, any repairs and maintenance, any legal fees. Maybe you had to evict some people, and you deduct those expenses from your income. And then you have what you call is your cash flow, or in other words, your profit, right? Income minus expenses, that's your profit. And that is what is taxable. Now, on the tax side, right, there are things that are acknowledged that are not acknowledged on the accounting side, right? Like depreciation. Depreciation is not a real expense that's paid, so you don't acknowledge it on your actual accounting books, right? So depreciation gives this faux expense because it's an asset placed in service, right? So on your tax side, it's going to look like you actually have a loss, particularly if you take bonus depreciation, right? But you still physically have the cash because for accounting records, right, the cash is still sitting in your account, but it's blind to Uncle Sam because within the tax code, there's an allowable expense called depreciation. It offsets this income. And that's what I mean by moving inside the tax code, right? You got to look at transactions where Uncle Sam says, all right, I'm going to incentivize you to engage in this transaction. I'm going to treat you favorably, right? Taxes are punishment for ordinary income. That's just what it is. Now, depreciation not only applies to real estate, but it applies to business operations. So if you have equipment or machinery and you take advantage of depreciation on your accounting side, right, you won't acknowledge depreciation because it's not a real expense. You don't pay it. But on the tax side, you will, right? So your taxable income is significantly less because of this expense that the tax code recognizes and allows you, and the accounting side does not. Right. So you physically still have the money, but the taxman says we don't see it because we gave you this expense. Right. So it's kind of blind to them. Another example of a difference between book and tax, which is accounting and tax. One is real numbers and one is accounted for in certain ways. Right. Is your meals. Right. Prior to 2023, in 2021 and 2022, we could deduct 100% of meals for business purposes. Right. Meals at a restaurant, for example. In 2023, we go back to 50%. So on your books, if you have $100 meal, let's say $100 bill you pay, and you have a business client, on your books, it'll go as $100 expense because it's actually what you paid. But for tax purposes, you're only allowed to deduct 50%. So you only acknowledge $50 of that expense, right? Half. And so that's what I mean by engaging in activities that are favorable within the tax code, right? I think about how every transaction I do is going to affect my tax return because that is how you build wealth, right? Wealth is the blueprint to wealth is in the tax code. That's just how it is. And that's how it's always been. People will tell you, hey, invest in stocks, invest in real estate, start your business, do this, do that. But all of it is really predicated upon how the tax code treats the transaction, right? Any gains off of sale of stock are taxed much lower than your W-2 income, right? Capital gains, when you sell your property, you have an exclusion, okay? And it's also, again, considered capital gains because it's a capital asset and you're taxed much lower than ordinary income, right? Particularly if it's a long-term gain, you have the asset over a year. So I just look at how the tax code is going to view every move I make, okay? I don't make moves outside of the tax code. I make sure that everything is strategic. I go for things that give me this faux expense of depreciation, right? Because, I'm allowed that in tax code. It's legal, right? It's legal tax avoidance strategies. If it wasn't legal, there wouldn't be a tax code for it, right? Section 179 wouldn't exist, which is your election to expense items that are normally not allowable to be expensed in 1 year. And section 469, which is your real estate passive activity losses, real estate professional status, right? I couple all of these things together to offset my tax liability, right? But that doesn't mean that I don't have the real income sitting on hand. It means that Uncle Sam doesn't consider it income to be taxed, okay? And that's what the tax code. That's what the tax code is doing. It's favoring certain transactions because it wants to incentivize you. So, thanks for joining in for a little tidbit. I just wanted to give you guys a better glimpse into accounting, which is revenue minus actual expenses, right? Income minus actual expenses, and then your tax accounting, which accounts for things that your book income doesn't, because it's not real, right? Depreciation is not real, or you can't take 100% of your meals anymore. You only can take 50%. So just think about that moving forward this year. Make sure you keep your records clean, separate your business expenses, get a business bank account. You don't want the IRS to say, hey, your hobby, should you be examined because you don't have an appropriate business account? These are things that can be done. They're all administrative. It's just some people are lazy. So I want you guys to go forward nice and clean. I will drop the link to the Tax Strategies Mastermind in the description box. So feel free to join on in. The cost is deductible to business owners and real estate investors. See you guys later.